sure I remember them. Iowa, Nebraska, Minnesota, the Dakotas, North and South Dakota, Missouri, and Kansas. I am in charge of Minnesota, Iowa, and the majority of Missouri. I don't have Kansas City, but I have St. Louis, which keeps me quite busy in regards to fair lending issues. And if you're aware at all of what's going on in St. Louis, that does keep me quite busy. And I have, in my portfolio, I have 3 offices, about 60 employees, and about 600 banks. The FDIC has, in our region alone, we have about 1,400 banks that we insure, that we regulate, primary federal regulator. As you know, we insure almost all of the banks. But we're the primary federal regulator of only state non-member banks. That means banks that are not members of the Federal Reserve System. And you know, I'll be quizzed over this later, right? So y'all, okay. And hello to my friend on the TV. I'm trying not to ignore you. And I apologize. I have a horrible cold. It might have been something to do with sitting outside at 4 baseball games, but I'm not sure about that. Yeah, the FDIC has insured deposits and promoted safe banking practices since 1933. So in honor of President's Day, do you know which president signed into effect the FDIC Act?
FDR.
Pardon me?
FDR.
FDR. Very good. Very good. I had somebody in my house fixing something. I really intended to buy. So Alex owes you candy. Okay, gotcha. And no one has lost 1 penny of insured funds since the failure and since the start of FDIC insurance. One of the things I'll tell you about a little later, one of my jobs, I've had multiple jobs with FDIC. I've worked there for almost 30 years. And one of my jobs in the latest banking crisis in 2008, I actually went around and helped close financial institutions. It was a very rewarding job, and that sounds really weird to say that it was rewarding to help close financial institutions, but I was actually the face of the FDIC. So on Friday nights when we closed banks, I was there helping talk to consumers, help make sure that they knew that they were going to be okay, and I talked to the media as well. I've got some really interesting stories. If we have time, I'll be able to share some of those with you. What is the FDIC's mission? Our mission is to maintain the stability of public in our financial system, ensuring our deposit accounts in the United States financial systems, examining and supervising financial institutions for safety and soundness and consumer protection. Again, I'm in the consumer protection area. Making large and complex financial institutions resolvable and managing receiverships. So we really have 3 primary divisions. We have my divisions, which is called DCP. We have Division of Resolutions and Receiverships. They're kind of slow right now, which is good. Those are the people that come in on Friday night. And I have a little video that I'll show you and what we do when we resolve an institution. And then we have our Division of Risk Management. Those are the people that go in, they do, and I used to work in that division as well. When you've been around for a long time, you get to work in a lot of different divisions within FDIC. But we usually go in and look at the bank's capital account. We look at all the loans to make sure that they're collateralized properly, and we look at all the assets and liabilities within a financial institution. To make sure the bank says what they have is what they actually have, and that the bank is solvent. We are an independent agency. Now, I'm off today because it's President's Day. However, we are not funded by taxpayer dollar. So I find it quite interesting that when anybody ever says to me, when they get really frustrated, they say, well, you have to do what I say because I pay your salary. No, you don't. I am not funded by, we are not a federal government agency. We are what we call a quasi-government agency. So you might want to guess. Okay. You might want to guess how we're funded. We are funded by deposit insurance premiums that are paid for by the bank. So we're an insurance company, really, in essence, and that's the way to think of us. We are not appropriated by Congress, meaning Congress does not set our rules. However, we do get all the benefits. We're what we call a quasi-government agency. We get all the benefits, like today off, but we get all the benefits of being a government agency, but we are not a government agency. And our funding, again, comes from deposit insurance premiums.
How about profits?
Profits? Yes. Our profits are all rolled back into the fund. Our fund currently is at about $50 billion. But that's okay because it's a reserve fund. So we make reserves to make sure that we can pay when banks do fail. We also have a very large, we have a $500 billion borrowing line from the Treasury Department. So in the event, and back in 2008, when everything really went south, and we were, and I'll show you the numbers here of how many institutions we closed, we needed a lot of funding. We never had to borrow on our line against the Fed, but we do have a borrowing line with the Treasury in case we do need to fund that. So we will never go broke. We may have a big IOU, but we will never go broke. There has been talk, and it hasn't been talked about it a lot, but as you know, a lot of people talk about Social Security. We have a big reserve sitting out there that's our money. A lot of people look at that often about, well, maybe we could use some of that money for Social Security. It's not come up recently, but that's something that people sometimes will talk about because we do have a pretty large premium. The other thing we do, we have certain statutory limits. When our limits get too high, meaning we're carrying too much money, and we lower the premiums for the institutions. So that's a good thing. We also, our pricing is also based on risk, meaning that if you're a riskier institution, and you're not, we rate our institutions 1 to 5. If you're a 5 rated institution, you're going to be paying a higher premium than if you're a 1 rated institution, which kind of makes sense. And if you're a larger institution carrying more deposits, you pay more because that's what we're insuring is the deposits. Here's, okay, that worked earlier. Let's see.
There are few ironclad guarantees in life, but here's one. Federal Deposit Insurance. Americans have counted on it since 1934. In those days, the insured deposit limit was just $2,500. Today, it's 100 times that. But the promise is the same. Whenever you put money into FDIC-insured deposit accounts and stay within coverage limits, that money is 100% protected, no matter what happens to the bank or the economy. That's some guarantee to keep for more than 75 years. Here's how the FDIC is able to do it. Deposit insurance is exactly that, insurance. But unlike an auto or home policy, the consumer doesn't pay the premiums. Banks and savings institutions do. The FDIC is funded by the banking industry, not taxpayer money. The premiums go into the deposit insurance fund. And as with any insurance, the higher the risk, the higher the premium. But what happens in times when bank failures are high and the fund is frequently tapped to protect depositors? There have been times when the fund has had a negative balance, even when it has abundant resources. This is because the FDIC is required to set aside a contingent reserve for probable failures over the next 12 months. The higher the projected failures, the greater that reserve must be. Since the FDIC is not allowed to offset that cost by future income, the net result on paper is a negative fund balance, even though total resources are positive. But whatever the fund balance, does not affect the FDIC's ability to protect depositors when banks fail. The FDIC has access to considerable cash from many sources. Besides the money currently in the deposit insurance fund, the FDIC receives quarterly premiums from the banking industry. It can also assess banks special fees and require them to pay premiums in advance. Then there are the unsold assets from failed banks. As these are sold, the proceeds are converted to cash. In 2009, the FDIC collected $10.2 billion in regular assessment revenues, plus another $5.6 billion in a special assessment. And at the end of the year, it required insured institutions to prepay 3 years' worth of insurance premiums. That raised another $46 billion. Based on current projections, on hand will be more than sufficient to handle bank failures from the financial crisis that began in 2008. The FDIC is committed to doing everything possible to be solely funded by the banking industry and would only seek public funds as a last resort. In such an unlikely event, the FDIC has a $100 billion line of credit with the U.S. Treasury. And then there's the ultimate reassurance. The FDIC is backed by the full faith and credit of the United States government. No matter what the future brings, the FDIC will continue to be a symbol of confidence for America's banking public.
So I misspoke. It's 100 million. I gave you some inflation. I'm gonna watch it again. Sorry.
There are
This one. Okay. So how is the FDIC funded? Oh, I already gave you the answer. All right, that's a gimme. All right. So what if you had money in the bank right now? How much is the limit for your insurance? 250,000, right? You can actually get a significantly higher amount depending on how you structure your account. So if you guys are worried that you only have $250,000 limit, if anybody's worried about that, I can talk to you, but you can get like up to $1 million, $2 million insurance.
So is that on a per person basis?
Yes.
Or is that, so what I've always wondered is, so let's say you got $1 million, you spread it among 4 different banks, and 2 of them fail.
Right.
So am I limited to $250,000 or would it be $250 at each of those?
It's at each institution, and then it's each person. So if I have a joint account with my husband, that's actually $500,000 worth of insurance. But it's each institution, so each charter has a separate insurance pot.
Okay.
Yeah.
How do you get the limit raised? Do you have to pay personal premiums yourself or something?
No, it's by how you structure your account. So like if my husband and I have a joint account, it's actually $250 for me and it's $250 for him. So the account itself is actually insured up to $500,000.
Oh, and then you can throw Alex on and make it $750 or something like that.
Yeah.
So you can kind of do some family structuring.
You can, absolutely. Yeah, we have a whole, part of my division has a whole section, nothing but insurance premium calculations, because it can get quite complicated. So yes, 250,000. The next. So in 2009 or 2008, the United States entered into the biggest banking crisis since the Great Depression. Does anybody know how many banks have failed since 2009? More than 5.
I would guess 1,000, and I'm just guessing.
Yeah. So anybody say more than 1,000? So this breaks it out. So 2009, we had 140. Our busiest year was 2010. We had 157. And banks are still failing today. Did anybody know that? Yeah, so we had 5 that failed last year. We've already had 2 failures this year. They were in the Chicago metro area. Now, the majority of banks, the good thing about FDIC insurance is that the majority of the institutions, and I'll try to go back and find that video that's embedded in that slide, most of our institutions, and with the exception of one that I went into, we find a buyer. So meaning that, for example, Great Southern here in town, one of the first closings that I went to was in Paola, and it was a bank called Tier 1. Tier 1 failed, and Great Southern bought it. So any branches of Tier 1 are now Great Southern branches. And that happened about in 2010 or 11. Don't quote me on that, I don't remember. Sometimes all the closings kind of run together. Does anybody want to guess what state had the most failures?
California.
No. They had the biggest failures, but not the number. No.
Florida.
Nevada.
Close. Georgia.
Wow.
Yeah. We made quite a few trips to Georgia. One of the interesting things is that failures typically happen on when? day of the week? Friday night. I actually closed one on Thursday night, and does anybody want to know why? Now, it was an Orthodox Jewish bank in the Bronx, New York. The Sabbath, because of the Sabbath, we had to honor their tradition and close it on Thursday. And that was a very interesting closing because we had to actually have a cultural lesson prior to. For example, what is the first thing as a woman you do, or anyone you do? You go out and you shake your hand, right? Nice to meet you. That was the first thing that you typically do. You cannot do that in that culture. Particularly, a married gentleman cannot touch another woman. So I had to do this a lot because that's my tendency. You want to get to know them. You want to reassure them you can do that. That was probably one of my most interesting closings. Anyway, so we've closed 491. We have a handful that are still on the list to close this year, but hopefully we will get that resolved.
Were the Chicago closings, when you said metro, was it near where all the homicides and stuff are taking place?
That I do not know. Yeah,
Curious.
that I don't know.
Contributes to
Yeah. Yeah. So this sounds like a lot, right? But do you know how many banks failed during the Great Depression in the 1930s? 600? 9,000 banks failed.
Wow.
It's estimated that 4,000 banks failed during the year 1933 alone. So does that say why there's probably a need for FDIC insurance?
Those folks would have lost out.
They would have
except
lost.
for liquidation.
Absolutely, yeah. There was no FDIC back then. So this is our region. We have an office, and this is just more. We have offices in San Francisco, Dallas. Obviously here it's in Kansas City. We have an office in Chicago, New York City. We have a satellite in Boston, Atlanta, and oh, I forgot, in Dallas we actually have an office in Memphis as well. So and then our headquarters is in Washington, D.C. We actually have offices in Puerto Rico. Does anybody want to guess why we have offices in Puerto Rico? Well, it is territory, right? We actually staff a full office in Puerto Rico.
The big one like bankrupt or
Right. Yeah. Another one of my interesting stories. One of the things that when you do closings, you can't tell your family where you're going. Yeah. So my daughter, who's Alex's younger sister by 3 years, she's not the favorite one. She, for many years, thought I was a spy. And she actually told somebody that because she was little, and I'm like, I can't tell you where I'm going, but I'll be gone for the weekend. I usually would come home on Tuesday. I would leave on Thursday. I would come home on Tuesday after we closed the bank and wrapped it up and everything. The only time I ever said where I was going is I had to go to Puerto Rico. We closed 3 banks, multi-billion-dollar banks in one weekend. And I just thought I said, I'm going out of the country this time, which is very unusual. The one thing that was really unusual about that closing is that, one, we closed all 3 at one time, and I was in charge of the Spanish translations. I don't speak a word of Spanish. So that was a pretty big challenge, and it was a huge media event on the island. And so we had gone into this high-rise to have some media coverage, and our chairman at the time was Chairman Sheila Bair. And I now know what celebrities feel like because there were media everywhere, and they were yelling our names, and there were cameras everywhere. So you see this picture of us, and we got shoved into this elevator, and they're shouting, Chairman Bair, Chairman. They thought I was the chairman of the FDIC. I'm like, no, I'm just just a pool worker here, and so that was pretty funny. I guess they don't see very many women down there in the banking industry, but like, no, I'm not the chairman of the FDIC. But that was pretty funny. But it was very interesting. The other thing is the culture there is for us to have, we always had to monitor how many lines and stuff were at the bank. So if there were any after the banks closed, there were lines all the time. Like I had to go to a shopping mall, there were lines in the lobby, and they're like, oh, this is just normal. This is where people go. They like to hang out at the bank, and they like to hang out at the bank lobby. And so we were very concerned that there was a lot of, people they were very concerned about it. they were like, no, this is just normal. So that I thought was really quite interesting. It's not something that you would see. People, do you guys go hang out at people's in the lobby? Yeah, just hang out for hangout. One of the things that happened as a result of the 2008 crisis is Dodd-Frank. You guys, I understand you guys are like looking at Dodd-Frank. Did you guys read all 2,300 pages of Dodd-Frank?
That's due next week, actually, so.
I am not an expert in Dodd-Frank by any means. The main thing but the one thing I really want to talk about is what happens, why do rules and regulations happen? Why does Congress, like the FDIC, we don't write rules, we don't pass laws, we enforce them. Okay, so Congress writes the rules. 2 congressmen wrote this rule. So
People try to take advantage of the system that's not regulated.
Yeah, exactly. So somebody does something wrong. And so consequently, somebody does something wrong. So what happens? Congress reacts and they say, we've got to make a rule so this doesn't happen to anybody else, right? So as a result, Barney Frank and Christopher Dodd wrote this massive piece of legislation that really covered these 8 areas. Now, I will say that the one I'm most familiar with is number 6, credit cards, loans, and mortgages. We are still trying to comprehend, it was 2010, so this is 2016. We are still dealing with trying to interpret and write rules for all of these things. It's a massive, massive piece of legislation, and it covered so many different things. It covers, like I said, I'm most familiar with number 6 because that's what we do. But it's new disclosures for all rules, all credit cards, new disclosures for loans, new disclosures for the mortgage rules. And what happens then when you have new disclosures and banks have to deal with that? So if you have to have new software and new disclosures to show how much you're going to pay for a mortgage loan, is that free? So who has to probably pay for that? Prices go up, not necessarily in interest, but what fees, things like that. So a lot of times these costs, which they were meant to protect the consumer, but a lot of times they were passed on to the consumer because somebody had to pay for that. Now,
I bet you raised a good point. So that gets dumped onto your lap, though. Like, the Congress has this lofty ideas, 2,300 pages, but they're not actually telling you exactly how to put that into.
correct. Yes,
and that falls on you guys.
Yeah, we have a lot. And we do it interagency. So it's the Fed, the OCC, the FDIC. We get together. We do interagency rule writing and interpretation. So we do that together. So yeah, Congress tells us what they want, and then we can interpret and write the rules and how to enforce them. So yeah, a lot of people think that we write the rules. We don't write the rules. Congress writes the laws. We simply write how we think that they would like us to interpret them and what their intentions are. So, and I think you made a good point. The whole transparency about knowing exactly what banks were doing. Have you guys ever seen the movie The Big Short? Yeah, I mean, that is so spot on. That's exactly what happened, and that's why we have Dodd-Frank. You know, the hedge funds, remember the part about that, or the risky derivatives? And I don't remember if it was Selena Gomez or whoever that was explaining the part about the derivatives and the hedge funds. I mean, she's probably pretty smart because that's exactly what happened, and that's why now we have rules about what banks can invest in and what they can't invest in, and the fact that that we as consumers need to know that. The other thing is that we also at the FDIC, we have been working very hard to work on resolution plans for the largest banks. So JP Morgan Chase, Bank of America, Citibank. Basically, we have been working with them to say, if something would happen, you need to work with us to see how we would help you, meaning that they have so many different pieces. They are not just a bank. They're investment firms. They are so many different pieces. How would we ever get our hands around that to figure that out? So, and one of the things that we often call that is a living will. So we work with them on their resolution plans and their living will to make sure that they can continue on. I can go back and try to show that video about the resolutions if you'd like, which I don't know which one of those.
Yes.
Okay. Would you guys like to see that, kind of how we do that?
When it becomes clear that a bank is failing, many things happen in a short amount of time. The bank's chartering authority, that is, the government entity that authorizes it to operate as a bank, generally gives it 90 days to take prompt corrective action. That is, to either recapitalize or sell itself to another bank. Financial regulators, including the chartering authority and the FDIC, prefer the bank succeed in this effort. But in case it doesn't, the FDIC uses that same 90-day period to make plans and be ready to implement the resolution process. This involves managing the closing and sale of the bank's operations to another bank. The FDIC has three main goals for any resolution. 1, keep its promise to insured depositors. 2, minimize disruption to bank customers and the local community. And 3, resolve the bank at the least cost to the Deposit Insurance Fund. Here's how the FDIC makes that happen. First, a team of experts analyzes and assesses the financial condition of the failing bank and estimates the liquidation value of balance sheet assets. The FDIC looks at many other factors, such as the asset and liability mix, market area, competitive and economic conditions, prior resolutions in the same market, the bank's branch structure, and business focus. Using this information, the FDIC builds a marketing plan, identifies potential buyers, decides which assets to include in the sale, and how best to structure the transaction. When the 90 days are up, if the failing bank has not found new funding or a new buyer, the state or federal chartering authority makes the decision to close the bank and sets a closing date, which is kept confidential. Now the resolution plan goes into action. Qualified bidders are asked if they are interested. Only banks with good ratings, adequate size, and regulatory approval are invited to bid. Private investor groups may also bid. Besides adequate funding, they must be in the final stages of obtaining a charter. Interested bidders who sign confidentiality agreements are given secure access to information about the failed bank and the type of transactions being offered. They may also visit the failing bank. After this due diligence, they submit 3-part bids. There's the premium on the deposits, the amount the bidder is willing to pay for the assets, and the bidder will assume all or only insured deposits. The FDIC is mandated to choose that bid that is best for the Deposit Insurance Fund. To do so, it compares all bids to one another, as well as to the baseline or liquidation value of all assets. This is the cost to the FDIC should it not be able to find a buyer. The best possible resolution is when all deposits are assumed and as many assets as possible are sold to the acquirer. That way, not only will depositors have uninterrupted access to their money, but also loans will be managed over time by the private sector to maximize potential recoveries. And costs are lower to the Deposit Insurance Fund and the FDIC. While the hope is always that troubled institutions will not fail, the FDIC stands ready to resolve them in the best possible way for all.
So that's kind of how a resolution works. As you can see, it doesn't happen overnight. Our best, what we really like is for there to be a whole bank transaction to where the bank, the assuming bank, takes over everything. So they get all the assets, the liabilities. We do what we call a loss share. So if the bank would, if the assuming bank would purchase something and then it would go bad, the FDIC would share in the loss of that asset. They're unable to collect on a loan or something like that. We are closing out most of our loss share agreements, paying them off early because the economy is really good right now, and the banks that have purchased other banks are doing quite well. So many times, however, we have owned institutions and run them for a short period of time. That's called a bridge bank. I've been involved in a couple of those, and basically we run bridge banks. We run bridge banks, or we do just a deposit payoff. If we do a payoff, meaning that we just pay, we write checks to all the depositors, and then we assume all the loans at the institution and all the assets. We've owned some very interesting assets and other real estate. We've owned airplanes. They tell me I can't verify this for a while, in not this crisis, but the last crisis, the FDIC actually owned the Dallas Cowboys.
Really?
Yes, because of a bank that failed. We sold them. But it is not our job. We are not in the business of running real estate or owning assets. But we have a whole division in Dallas, our DRR, Division of Resolutions and Receiverships group is in Dallas. And we run all of our asset sales through them. So a lot of times right after the crisis, we had bulk sales of assets to investors. The interesting thing is that as an FDIC employee, I can't bid on any of those. Any home that is owned by the FDIC because of our foreclosure activity on an institution, I can't bid on it. So good and bad. So yes.
You guys do more payoffs or more purchases?
Yeah, we actually do more whole bank transactions. Yeah, meaning that other banks bid to purchase the institution. Yeah. One of the things that's really slow right now, but we're really trying to ramp up, and it's in all parts of the country, is what we call de novo activities. You guys know what that means? You heard of the term de novo? It's a brand new institution. So people are just not starting brand new banks. They are looking for smaller institutions to purchase, things like that. But just for an investor group to come together and start a new bank, we are just not seeing that. We're seeing our charters shrink in size to the number of banks, but there's still like 6,000 banks nationwide, all charters. So, and that's even with all the failures that you saw between 2008 and 2010. But we are hoping, the other thing that we are very concerned about at the FDIC, particularly in the Kansas City region, we are watching closely, and we have people that monitor what we call depopulation. Depopulation primarily in western Kansas, the western part of North and South Dakota. There are places that don't have a lot of population growth. So there are banks there, but the management of the banks, you're smiling like you know this for sure. I grew up, the town I grew up in is in a depopulating county. So the management there is elderly, and nobody wants to go in and run the bank. So, and maybe their families, their friends, they really want to come to a bigger city. They don't want to stay out in, say, western Kansas or western Dakotas and things like that. So we're very concerned about the viability and the continued viability of the banking community out in those areas. And then we're monitoring that on a close, we monitor about every quarter to see, how that's going. We monitor our banks out there. So we have a whole division of insurance and research that does that as well. They also do economic trends. How we monitor risk in our banks, we do economic trends like the ag. Kansas City is ag central, so we monitor the drought conditions, prices of soybeans and corn and things like that. We monitor that on a regular basis as well, because we have a lot of banks that's their primary lending source. Yeah.
You talked about how the FDIC rates banks. Has there been any competition from the rating agencies to take over that? And if not, why not?
Yeah, there has not been, because we rate them differently. We go in and examine them, and our rating is the same for the Fed and the OCC. The rating agencies really haven't touched that yet. And it's interesting because we talk about transparency, but our ratings are private. They're covered by Part 309 of the FDIC Act. So you don't know. You don't know what People's Bank is rated, or Great Southern, or Citibank. That is all private, and if the bank would disclose that to you, they are in violation of 309. Now, they can say well rated, or but they cannot tell you. There's only a couple ratings. There's a couple things that can be disclosed. What I do is called the Community Reinvestment Act. It's how a bank is reinvesting within their community. That is public. And it's rated on not 1 through 5, but it's outstanding, satisfactory, needs to improve, or substantial non-compliance with the Act. That is a public document. That's public. The other thing is public if a bank would ever be assessed a civil money penalty for their actions, meaning that's something you don't want to see. They've probably made some mistakes, and we are penalizing them. That is public, and it is many times that is public in the newspaper. It is a public document.
What are the most common reasons that, especially the banks, these last 7 that have closed, what things are they doing that they're not making money?
Right. Right now it's commercial real estate because of the areas that they're in, so they overinvested in commercial real estate. Those are primarily strip malls, apartment complexes, things like that. So they overinvested in those, and everybody right now wants to get into these multifamilies. Everywhere you go, there's cranes and stuff like that. So they just overinvested and were not well collateralized. So it's poor investment choices. We ask the banks to keep what we call a reserve for loan losses. And that we would hope that would be able to cover them, and we ask them to keep a certain percentage of their loan portfolio within a reserve account, as well as we ask banks that are riskier to keep a higher capital account. Sometimes that doesn't always work, because if you're in trouble, you don't have that extra money to keep in your reserve, so it's just kind of this vicious circle as well. But yeah, I would say overinvestment in real estate. So we have not had any ag banks. The crisis when I first started with the FDIC was an ag crisis, meaning that we had a lot of small ag banks fail just because farmers got overextended and were not able to repay their debt. If you're not able to repay your debt, what happens? The bank can't make their payments, so then they fail. So each crisis has been kind of had their own, but this last one I think was primarily.
I've got another question that I don't want to be taking up time. Anybody else? Go ahead. Okay.
So when Glass-Steagall was
Oh,
revealed,
you're right on my line. That's actually written down.
how did that affect the FDIC? Because now suddenly you open up these banks to be, it wasn't just a bank anymore. They could do investments.
Right, right. It made it very hard. It's very difficult to regulate all of those things, and it made we actually did, it used to be that I did both. Actually, I did everything. I did trust, risk, compliance, and what we call our technology. We had to, which if anybody knows me in technology, is just hilarious. But we very much had to specialize. So now we have to very much specialize. We have people that only do trust accounts or trust examinations. We have people that only do IT examinations. We have people that only do risk examinations. We have very much had to specialize what was going on. So one of the things, not along Glass-Steagall, but I think it's going to be very interesting. We are watching closely what will happen with the Trump administration, particularly in our area, being consumer protection. The CFPB, which is Consumer Financial Protection, that was enacted by President Obama. It regulates for consumer protection and a lot of other things, not just banks. They've got everything. They are right in the line of fire for the Trump administration. We work closely with them. They take our banks that are over 10 billion. We don't look at banks over 10 billion because CFPB does. We look at a few of the regs, but they are very much under scrutiny for the Trump administration to see if they want to continue that organization or not. They are a one-person. We have a 5-person board. They are run by one person, and so that is the setup is interesting, and that's, I think, probably why a lot of people are kind of weary about them. But so we're kind of interested to see what happens right now. We are currently, I'm not supposed to call it a hiring freeze, but we can't hire anybody. So we're kind of waiting to see what happens with that as well. So even though we're not a government agency, we still follow the rules, and we're kind of making do.
In relationship to Glass-Steagall, which I'm not sure everybody, we're going to talk more about the Glass-Steagall Act. They might not be totally on board, but I was wondering, with what you see in the banks, do you think we should move back to that system and not allow certain types of banks or whatever to get involved with the more investment type activities?
Okay, this is my
Like,
opinion,
that's what I
not
mean, you're off the
the
record.
FDIC's. You know, I think in this day and age, to be competitive, it would be difficult to go back. I just think it'd be really difficult. One of the things that we're exploring right now, and there's a lot of talk about, is what we call a Fintech Charter. Meaning that right now a bank we cannot charter a bank that does not take deposits. You know, we're FDIC insurance. But there's some real chatter about, are we going to do what we call Fintech Charters? So all these financial technology firms that basically want access to the payment system, but that do not take deposits. And how does that work? I think that Glass-Steagall is great. It's kind of antiquated. And so in order to, I just think to be competitive, I think it needs to look at it. That's my opinion, not the FDIC's. So there's just a lot of technology changes, and a lot of the rules and regulations we're finding are very difficult to enforce because they have not kept up with technology. Most of our regs, Reg E is one that talks about electronic, Reg E, electronics, yeah, but it does not cover mobile banking. I mean, it's so far behind. It doesn't cover about mobile banking, online banking, things like that. So those are things that really need to be brought up. So many of the rules, unfortunately, are kind of antiquated and just kind of behind the times. So we make do with what we think would have been interpreted had they had those things. So how many think the FDIC examiners are auditors? Like when we go into a bank, yeah, we don't audit. We don't audit a bank, and that's a common misconception. We go in and look. We do very scoped exams, but we are not a bank's auditors. We're not their consultants. We just basically and sometimes it's easy for me to explain that I am an auditor, but we do not audit. We simply look at what the bank has, but we do not do in-depth audits to the institution. We ask them to outsource that to another party.
How many banks, I mean, do you always get involved when a bank is in jeopardy in some sort, or is it able to be handled privately, or because you're monitoring things, you're just always involved? Like if a bank wants to buy another bank, they're struggling,
yeah.
Can they do their own private deal without you getting involved?
No.
Oh.
No. Everything requires an application with the FDIC, so we are involved at every stage. And in fact, if they want to open a new product, something like that, we have an institution that wants to, they want to do something pretty interesting about it's like health savings accounts, but it's kind of quasi, they actually have to get our approval as well. Banking is the most regulated industry there is. And we hear about it a lot. They're not very happy about that, but it also leads to a lot of protections, because I think without all of those protections, we've seen a lot more failures. So, but banking is one of the highest regulated industries there is. Yeah, they have to come to us for everything. Even if they merge two banks together, merge two holding companies together, they have to go to the Federal Reserve, and we look at that as well. And we are actually allowed to opine on that from both the risk side and the compliance side.
All right, folks, we got about a minute left. Any minute or two? Any last second questions? Last call. Well, let's give Janet a round of applause. Interesting. Thank you for taking time.
Thank you so much. And the other important thing I forgot to tell you is that I'm actually an OU grad as well. So
Oh,
didn't know that. So yeah. So
And what was your major?
business administration.
Okay. It's been a while.
Yeah.
Oh,
So
cool.
best of luck to all of you. Thank you so much for the
Thank you.
opportunity.
Thank you. Yeah, I did not know you very well. Okay, so chapter 1 of Allison is up on the portal now, or the Blackboard, so you guys can get that posted for Wednesday. And then he has a few things to say about FDIC and other things too, so we'll
Maybe I can defend myself.
Why is Alex not on your back?
I don't have a picture. Go ahead, take it. Yeah. Poor Alex.
Well, those are a couple good videos for me. I keep an inventory of
We
videos
actually have
like
a
that.
YouTube channel.
Yeah, I what's that?
We actually have a YouTube channel.
Oh,
Which is weird, but
yeah. I don't know if Alex told you, I keep a Rusty Con Rocks YouTube channel as well
oh, cool.
for that stuff. So.
Good to see you. Bye.
What are you doing?
Cleaning up.
Well, yeah. Well,
That makes it
thank you.
Yes, thank you. Say hello to your parents for me.
Will do.
Oh.